Is it?
Finance Conference Canton Schwyz, presented by the following main sponsors: UBS, Interaction, Swiss Life Asset Managers, Ernst & Young, Drooms, Novus Partners, and the following co-sponsors: Schweizer Kantonalbank, Wirtschaftsförderung Höfe, Matic Suter & Partner, Business Network Club Zürichsee, Marketing Business Center, a company of Regus Group, Etzel Real Estate.
Thank you and welcome back. Hope you enjoyed the coffee. I expect lots of questions now that you're all more awake as we follow through with transparency as the overreaching trend in the financial services industry in relation to tax. We're very privileged to have Jochen Jaeger, who's going to be covering the whole topic. He's at Ernst & Young and a partner there in financial services. What I thought was very interesting about his background is that he started as an options trader in London, then became a tax advisor, first with Anderson, but then also tax director with Julius Baer before joining Ernst & Young. That gives him 20 years of practice in the field, and I hope he will focus on operational tax issues because he must understand that particularly well in view of his background. So let's welcome him. Thank you.
Thank you very much. A very good morning to you. The company for which I worked as an option trader as well as Anderson don't exist anymore. So you could see I left a trail of devastation behind me. Transparency is today's topic. And I have a 10-year-old daughter who asked me some weeks ago, Daddy, what is a tax advisor really doing? And that put me into a kind of stressful situation. I tried to explain her, well, sometimes, some weeks ahead, I will go to lovely Pfeffikon to talk about a very displeasing topic that nobody really wants to hear, and that is how I earn my salary. And the reaction of my daughter was, cool if you earn your salary like that. Transparency is really the overarching topic in the financial industry, I think, in the coming years. Why? Maybe it's worth or warrants the time to look at how transparency as we perceive it today, as we know it today, came about. I think we have transparency since ages. There are double tax treaties which you can employ to get some information from other countries. I think the first institutionalized transparency was back in 2001 when the QI system was introduced, where the US really said we want to have data on US persons having accounts with foreign banks, with foreign financial institutions. Then basically nothing happened for about 4 years until the EU said we also want to have this kind of information, however coupled with a kind of withholding mechanism, and the EU Savings Directive was introduced. In 2009, the US really took a stance on UBS. You know the case UBS, and one of the corollaries of the UBS case and of FATCA being perceived as having too many loopholes is FATCA. FATCA came in the year 2010, and almost concurrently the negotiations with Austria, Germany, and the UK on the final withholding tax agreement, which entered into place. Now the entire transparency discussion has also another tweak when it came to shaming and blaming corporations for having letterboxes in some other countries. So the entire OECD focused on getting more transparency, getting more information out of companies which operate in other countries, maybe only with a letterbox in the extreme case. They want to have information on that. As I said, it comes in different shapes or forms. The transparency is two-sided. First of all, it's the corporate transparency, where tax administrators, where revenue authorities want to get more knowledge of what a company really does in a country. The other side of transparency is actually the customer focus. So the transparency and information that a bank needs to disclose on customers. We will focus on the latter today, but the banks and the entire financial industry is really at the heart of it, because they are taxpayer themselves, and they have to put themselves into the shoes of a foreign tax collector, because the foreign tax collector wants to have either money or information. This is a statistics which was promulgated by Frankfurter Allgemeine Zeitung back in 2010. I don't think the numbers will be materially different today. This is the monies stashed into Swiss bank accounts and into Swiss custody accounts roundabout from European provenance, roundabout 1 trillion Swiss francs. The yellow bars are those bars where the FAZ, or the one who actually compiled these figures, thinks these are undeclared monies. The gray bars are the declared monies. I will not comment on any countries like Italy, France, Spain, or Greece here. This is how the foreign tax administrations, if they see this kind of statistic, will perceive the problem. That pretty much resonates with another study published by the Boston Consulting Group, and I just want to draw your attention to two figures. In the horizontals, you see where the money comes from. Where is the provenance of the money? And in the vertical columns, you can see where the money is actually booked. This $0.93 trillion stemming from Western Europe pretty much resonates with the figures promulgated by FAZ. Interesting, what I find interesting is if you look at the money stashed into Swiss bank accounts coming from the US, which is a mere, and I don't want to belittle this figure, which is a mere 40 billion Swiss francs. So if you take FATCA with all the operational costs entailed by FATCA, it's quite disproportionate, because literally every financial institution is affected by FATCA, and the administrative costs entailed by FATCA, they are huge. When we're talking about transparency, this is predicated on one assumption. And the assumption is I can identify one taxpayer, one single taxpayer in an unambiguous way. The US is particularly good in that because they have the social securities number since ages. And every US person is allotted its own unambiguous social security number. And what the US is trying to do now, and I think many other countries will follow suit, is doing a kind of matching mechanism. Because if they receive as much information as possible from the taxpayer, and they receive as much information as possible from financial services provider worldwide, and they can match these figures, and they reconcile these figures, if there is a matching, by definition, there can be no tax mitigation or tax avoidance. This is what the US is trying to do, and this is what FATCA is really all about. You will see the slides are pretty much the same if Jakob Schatz talks from the Swiss banker's perspective, or if I talk from the advisor's perspective. We see many initiatives running concurrently now. Just starting at 1 o'clock in this clock here, the EU Savings Directive, which is probably going to be renegotiated to also embrace dividend income beside the interest income or other income, for instance, capital gains. The final withholding tax agreements currently in place with Austria and the UK, which I personally believe will not exist in a couple of years, because if we once have automatic exchange of information, I think it doesn't make sense to have a kind of withholding instrument any longer. The double taxation conventions. We have around 7,000 double taxation conventions worldwide. More than half of them contain a clause by which the requesting country can ask the other country for information on the taxpayer. So we already have this kind of transparency, however, it's not used at the moment. The different Gs, the G5, the G8, and the OECD, all advocating the automatic exchange of information. The question here is, what kind of information will we exchange? Will we only exchange the information that Mr. Jaeger holds an account, say, at Credit Suisse? Or will we exchange the information saying Mr. Jaeger has bought that and that many Siemens shares on that date in order to be able to really tax him properly in his home country? You see that that's two extremes here. The breadth of national measures. We have a lot of countries running self-disclosure programs at the moment, probably in anticipation of the automatic exchange of information, just to give their taxpayer the opportunity to go into the white space and then leave the black space. QI system and FATCA currently, and last but not least the FATF, the Financial Action Task Force, which combats money laundering, and they want to take all tax offenses into the realm of predicate crime for money laundering. And if a money laundering case is investigated, the measures taken by the police, by judges, by prosecutors, by financial intelligence units and the like, they are much more pervasive than if only a tax offense is being investigated or interrogated. This is not supposed to test your vision. It's a letter endorsed by the 5 finance ministers of the G5 countries, and they basically say we congratulate and support the US in having this idea of FATCA because we want to piggyback on that. The US has sort of invented this whole transparency mechanism, and we want to use it for our purposes just as well. So the G5 countries really welcomed the initiative of the US implementing FATCA here. This is the landscape of countries which the US currently either are in negotiations or they are exploring negotiations in transposing FATCA into national law, international transposition here. And if you see this world map, it pretty much covers the most important investor countries, save maybe at the moment for the Middle East. And ironically, if the US has closed an intergovernmental agreement with, say, 50, 60, maybe 70 countries who say they will transpose FATCA and they will abide by these requests for more information on US persons, you can get rid of FATCA in the US again. That's a little bit ironic, because I don't think the US will do that, but I'll touch upon that in a second. The OECD report, which was submitted to the G8 summit a couple of months ago, really says we want to foster the automatic exchange of information. And in order to do so, we first of all need a kind of multilateral framework which we can use because we have the double taxation conventions, we have the double tax treaties in place. So why don't we just introduce a kind of FATCA legislation into these double taxation conventions? And by doing so, we would have multilateral agreements exchanging information on taxpayers all over the world. Then you would need to have a kind of national legislation in order to divulge and in order to give the information to another foreign fisc. And last but not least, you would have to talk about the granularity of the information that you exchange. The example that I gave a couple of seconds ago, what kind of information do I really exchange? And last but not least, we would need to have a kind of common IT standard to really exchange this information and to prevent kind of data repositories which are never being used. What is the response of the market that we are currently seeing? If we look at this client transparency, we see a kind of pyramid. First of all, there will be banks which say we will comply with the rules imposed on us by the regulator, imposed by the legislator. But I think probably just being compliant will not suffice in the future. And therefore, we are seeing other market participants saying we will look at our client base and apply a kind of risk mitigation and apply a kind of targeted risk resolution in order to see which clients are in countries where the measures are more pervasive than in other countries, tackling Switzerland for information. And top of the pyramid, there are other companies which say we will take this kind of transparency as a kind of business model, a business enabler. There are banks which are SEC registered or have SEC registered units. They are saying, instead of other banks ousting or exiting their US clients, we will gladly accept these clients, provided they furnish proof to us that their monies are really declared. And they are currently gaining assets under management. Let me embark with you in a little thought experiment. Probably you have all heard of the prisoner's dilemma somewhere or sometimes during your studies. There are two thieves. They have committed a crime together, and now they are arrested. And what happens is the police tells both thieves, if you confess, you will not be punished. You will act as a principal witness, but the other person will be convicted. So basically, you have two participants or two actors acting independently, but the way they act has a ramification on the situation of the other person. So if we translate that into the current situation, I think we have these two actors, the banks and the clients, and they have two possibilities. Either the bank discloses and furnishes data on the client, or the bank, and I put it in inverted commas, just muddles through. They are just saying, we don't do anything at the moment, we hope for the best in the future, and we won't take any action. Basically, the client has the same choice. He can say, I will go into a kind of self-declaration, a self-voluntary disclosure, or I can muddle through. So what happens? If we look at what could happen to the persons. Let's assume the bank and the client collectively decide we will muddle through, we won't do anything. So I think likelihood is very high in the short term that nothing happens. The bank will not appear on any radar of foreign revenue authorities or foreign prosecutors, and the client will not appear on the radar of his foreign fisc. If both confess, there is a cost to it. Both will suffer -4. However, if one confesses and the other does not confess, then the situation for the other party deteriorates. Because if the bank, for instance, discloses the client, but the client does not disclose himself, I think he will be very likely to face questions from his revenue authorities at home. Likewise, if the client disclosed, but the bank doesn't do anything, the bank might suffer a kind of reputational damage in that you appear on the front page of the financial gazettes. This is the situation. However, opposed to the prisoner's dilemma, you don't have a kind of equilibrium because let's assume the bank decides I will disclose the client. Then the client, having this kind of information, will have to disclose himself as well, because otherwise he faces repressions, he faces questions by his revenue authorities. This is the short-term side. I think the long-term side just changes one of the squares here. If you look at the long-term perspective, muddling through will not be possible. Because when we have transparency, when we have forced transparency, a bank that doesn't disclose any client data or a client that doesn't disclose himself and then it stays in the black realm will suffer heavily. And what does that mean? We have an interesting situation in Switzerland now because the banks are really deprived of having the choice. The politics and the regulators tell the banks unilaterally in Switzerland, muddling through is no option. You have to become compliant. There is a kind of white money or assets declared strategy here. So the bank does not have any choice any longer. And therefore, it's clear for the customer in which direction he would have to go. The customer would have to go into the direction of going into a kind of self-declaration, going into a kind of disclosure initiative in his home country. Let me gaze a little bit into the crystal ball for the last few minutes. Once we have transparency, once the banks deliver data or have to deliver data, and once we have an international standard of the exchange of information, what does the world of a private banker or what does the world of a private bank look like? And I've just jotted down a couple of hypotheses here. I think we will have less banks, and those banks who find it difficult to shoulder the entire compliance costs will either merge or will cease doing business, or will try to escape into not, and I put it in parentheses, into not yet regulated markets. We will have a change from pre-tax to after-tax performance. So the client advisor must be able to have an educated discussion with his client and to see what are the tax ramifications of putting one single product into the client's portfolio. Therefore, I think we will have more standardized products in the future because it's costly to explore what are the tax consequences of one particular product in the context of one particular client. So standardizing products makes it more easy, more or less difficult to get an idea of what the tax ramifications are. I think it almost goes without saying we will have higher costs, we will have margin pressure, and I think we will see different or differentiated pricing models in the future. Because if I were not a US person, and I know my bank charges me fees for running my accounts, I would probably be prone to tell my bankers, look, I'm not a US person, but do I, in my pricing model, pay your fees that you just encounter because you hold US persons? Higher risk of being sued. I think that's also one trend that we can see, that we will see in the future, because very bluntly, if an undeclared client had a loss in his portfolio, what would he do? Most likely he would probably bite his tongue, say nothing, and hope for the better in the future. I think in the future, when the client is declared and he knows my revenue authorities in my home country, they know my tax situation, I think I'd be more prone to sue my banker for a kind of misadvice, if you will, if I think the banker really misadvised me, because it doesn't matter for me if it somehow erupted in my home country that I have money stashed into a foreign bank account. And concentration on core markets, I think because the client advisor needs to be able to have this kind of educated discussion with the client, I think they can only concentrate on a couple of markets, maybe only on 2 or 3 markets, because they have to have the knowledge what the tax ramifications of the position of the client are. As a matter of fact, it really impacts the entire value chain in the banking industry, starting from the client onboarding, then going through the portfolio composition or discussing how to set up the portfolio, the documentation and reporting. As a client in the future, let's assume I was a client resident in Germany, I would ask my bankers, look, I get a report from Commerzbank, from Deutsche Bank, free of charge, delivered to my home. Where is this report from your side? Can I please get this kind of tax report that my tax advisor uses to fill my tax declaration? Special situations. I think undoubtedly or invariably we will see a huge number of requests under double tax treaties for exchange of information. I think the US is already gearing up because they receive a huge number of maybe recalcitrant clients which are uncooperative, where the bank says, I would like to identify you, but you don't give me enough information to really identify you. These clients will need to be reported to the IRS under FATCA as from 2015. And the US will certainly make use of their double tax convention, which embraces this provision of exchange of information. And last but not least, the client remediation or exit. We currently do see a number of banks who say we will say goodbye and farewell to a certain category of clients. We don't want to service these clients any longer. Last but not least, let me finish with almost one kind of bon mot. We all know FATCA is going to be the pinnacle of tax transparency in the future. We all know FATCA is going to be very costly for the banks. And this is a letter of the congressman sent to the Department of the Treasury, or to the head of the Department of the Treasury, and that's quite interesting because the US said, if we need to reciprocate on information exchange, our US banks would need to start collecting the information that all the other banks around in the world will also collect under FATCA. And you can very well imagine that this is that this is not very well received by the US banks. Political pressure is building up now. And the funny thing is, if you read the letter, and that's why I put it in bold letters to the side, it simply says, well, these mandates, so collecting information by US banks about foreigners, would not themselves bring any penny into the US Treasury. They would discourage investment in the United States. I wouldn't have thought that. And then, just continuing, they would further impose costly compliance costs on American banks and credit unions. It's quite interesting to see. I've never seen non-costly compliance costs. But anyway, the best thing is if you see the last or second page of the letter, given the evidence above, it's difficult to conceive any circumstance that would justify imposing such an expensive counterproductive domestic mandate. So I think with some time, like the US is deliberating or thinking about what FATCA really means, now apparently to themselves. With that in mind, I think I can turn over again to Jérôme.
I mean, there is a lot in this speech. Do we have any questions or comments to elaborate a bit on tax disclosure? I mean, it's affecting everybody in this room. I mean, one thing that comes to my mind is the only people who are going to make money here are IT companies.
And advisors.
Clearly. So we're okay.
Now, maybe you have heard it. Let me answer in two things. The first thing is, you know what FATCA stands for? It's the Full Employment Act for Tax Consultants and Advisors. The other thing is, I'm literally always being asked, look, this is like manna falling from heaven for you. And I say on a very short-term basis, yes. On a very long-term basis, or even on a medium-term basis, probably no, because some of our clients, smaller or medium banks, will say the compliance costs are so exaggerated that we will find it difficult to really cover these costs by the revenue that we do with our clients. And so I think the necessary decision is we will go out of business. And then I don't have a client any longer, which hurts me much more.
And that's the thing. Do you have any statistics on how punitive this will be? Because we're turning every bank, every financial institution into a tax collector.
Yeah.
Do we have any stats on the impact of that?
No, I think you can't have any stats at the moment, or at least if the bank said they would not disclose, not to us. Yeah. But I think, yes, FATCA is going to be incredibly expensive. I think if you're talking about larger banks, and it's not the consultants' fees, it's in particular it's the IT fees, because at the end of the day, a bank is an IT company which happens to have some clients.
I agree.
At the end, it's so big numbers that you are going into the tens and hundreds of millions in order to comply with these FATCA issues, and just multiply it by maybe 200 banks in Switzerland, and that's only Switzerland.
So our last hope is political leadership and common sense in the likes of Bill Posey there, and trying to really lead us out of this potential frenzy.
The question is if at all he will be able to lead us out of this frenzy. Because I think the US in the meantime have invested so heavily in this system. The IRS are currently employing 3,000 more people, and these are not people investigating banks somewhere else, but just handling or trying to handle the information that they expect they will get out of FATCA. I think politically it's almost irreversible in the US now. And with the OECD now really jumping on the bandwagon, trying to piggyback on the FATCA initiative, I don't think we will see a reverse, at least not during the time until I retire.
Food for thought. Okay, well, thank you very much. Thank you, Dr. Jaeger. Our next speaker, Dr. Patrick Frost, will address managing big long-term assets in times of slim long-term rates. I know this is a topic that will be very interesting to many of you. Even during the coffee break, we're all talking about interest rates and what's the long-term picture. Dr. Frost is now the Group Chief Investment Officer at Swiss Life. He started his career in the mid-90s working for Winterthur Group. He was a corporate bond manager, so that should give him plenty of practical expertise. For 2 years in the USA, he was head of fixed income, eventually at Winterthur Group. So I look forward to his insights. Thank you very much. Where is he? There he is. Thank you.
So you mentioned the break, and just in the break I did get one question I frequently get is, why don't Swiss insurance companies invest more in alternative assets? So I hope I'll give you some answers here. And interestingly, this afternoon, a colleague of mine working for another insurance company, a non-life insurance company, might give you some more favorable perspectives here. So I'd like to give you an overview of what are attractive asset classes for this big pot of money that we manage as life insurance companies and which are much less so. So first of all, I guess you all know that we insurers manage a big pot of assets. So we're second right after pension funds. These are figures from the OECD. And you find many of the rest of you a bit further down. Now I know obviously there are quite a lot of alternative investment managers here seeking to get a little bit more know-how on how to get the hands on managing the assets further up here in the food chain. And the good thing for us is that we're also growing here according to the OECD, more or less 5% per annum. Now, there has been one development which has really been a revolution for us here in Switzerland, working for an insurance company, especially for a life insurance company. And that revolution really came from Bern, from FINMA. That was a reaction to the heavy losses incurred by the industry at the beginning of the last decade, and that led to an economic solvency framework. And this economic solvency framework really gives us a huge incentive to invest into assets which are very well aligned with the maturity profile of our liabilities. Now, Swiss Life's business is basically providing saving products and pension products over many decades. So a part of the big savings, forced savings we have in this country lands on our balance sheets, and we give guarantees for that, and that's why clients like coming to insurance companies. And this solvency framework not only gives us the incentive to align our assets with our maturity profile of the liabilities, but also, and even more importantly, to invest into assets whose price behavior is very similar to the change in value of our liabilities. So what does that mean? Risk-free assets for us, unlike, I guess, for everybody else in the room, is not cash anymore. So it's not an asset that just retains its value. Risk-free for us in our economic framework under which we have to operate is actually a 15-year Swiss government bond. So which, you know, could lose a lot of value in the coming years, but has, of course, gained a lot of value in the past couple of years. So to sum up, we have huge incentives to invest into assets which correlate well with fixed income assets because that reflects value movements of our liabilities. Now, as you know, here in Switzerland and also in this canton, we have extremely sound public finances. So which is great for us as citizens and businessmen, but it's not so great for us operating under these rules. And this is what this chart shows here. So we see the stock of outstanding debt of the Swiss Confederation is a bit less than 100 billion Swiss franc. That's what you see on the right-hand side of the chart. By pure chance, that is the same amount of money that I have on Swiss Life's balance sheet alone for the Swiss business we're in. We also have some monies in France and Germany, but let's leave these aside. And what makes it even more difficult is that there are almost no very long-dated Swiss bonds outstanding. Actually, those are only 15 billion worth, so really a fraction of the money that I manage, or I'm responsible for. And of course, as you can imagine, all of these bonds are stashed away either in our accounts or in those of our direct competitors. Now, so what would you think, what is the next asset class that we turn to then, if there are not enough Swiss government bonds that go around, of course? Well, the next ones are Swiss banks, probably, Swiss cantonal debt, municipal debt, and so on. And one very important asset class for us, which has a huge tradition in life insurance in Switzerland, but also in other countries, is actually real estate. So we're the owner of the largest private Swiss real estate portfolio. And so that's around 17 billion Swiss francs. That's the overall portfolio. But about 85% of that, or 83% of that, is Swiss real estate. So that's really good for matching our liabilities. There are another 6 billion which we manage for external clients. And so if we put that together, we manage about real estate worth about 4% of Swiss GDP. Now, how has the financial crisis treated us? Now, there are several ways, of course, to look at that. But one of the ways to look at it is, well, if you look at the net investment result, that's another way how we are regulated, then we have been positive in each and every year. Even in 2008, we've delivered positive returns. And if you compare us with banks, you see that the dividend flows, and here I'm not talking Swiss Life, but the industry overall, that the dividends coming from insurance companies have been much, much more stable than what we've seen from banks. And one of the important reasons here is the investment income that we generate, the recurring investment income. So those are coupons, dividends, rental incomes, and the like. That has been quite surprisingly stable. And of course, one of the reasons for this huge stability, even though rates are much, much lower, we've had a remarkable resilience here. That's because very few of our assets come due. If you can imagine, the average investment is a 15-year bond. It's only around 4% that comes due every year. So we basically, if we invest 30-year bond every year, 3 or 4% of our assets, you see the average will be 15, and so only very, very few bonds actually really come due and have to be reinvested. For banks, that's a totally different game. There, the duration is much shorter, and so a lot of their money has to be reinvested at much lower rates, and so investment income comes down quite quickly. Now, the remarkable thing, and that's another question I actually get a lot, I mean, how do you deal with this extremely low interest rate environment? This is, you see here, the 8 or 9 year track record, basically, of our Swiss government debt. It's a 10-year bonds. As you know, we even sank below 0.5% a few months ago. Now we're above 1% again, but we really reinvest at extremely low figures. So how do we manage to deal with that? How do we manage to keep our investment income, the recurring one, between 3 and 4%? Well, one important reason is, of course, that we draw on this portfolio that we took decades to build up. So there are, of course, a lot of very high coupon bonds in there, and of course, rental income from real estate is also quite attractive, and in addition to that, we also have a lot of corporate bonds on our balance sheet which generate high income. Now, how does the regulator decide how to split incomes of an insurance company between clients and shareholders? Well, here, the main thing that they look at is our net investment result. So that's the recurring income minus losses, as in 2008, or plus gains, as in the last couple of years. That's the key determinant that we want to manage, that we want to keep as stable as possible. because if we don't do that, as we experienced in 2008, if we fall below the level of guarantees that we've provided to our clients, we produce a huge loss. So even though we were positive here in 2008 with our returns, we were below the technical guarantees here mentioned in the bars. That is what we promised our clients, and the shareholder has to make up for the difference. And that's why we produced a 1 billion operating loss in 2008. And that after having done similar things in 2002 and 3 and so on. And that's why the regulator then said, well, forget about that, you're going to have to change your ways. Now, the last way to look at our return on assets is performance. That's simply the total returns that we've generated on our balance sheet. And these are annual figures here. And you can see we just tanked slightly below 0 here in 2008. And ever since, we've seen a huge reinflation of the assets that we hold. Now, why? Because everybody was looking for assets that really deliver stable incomes. And so our real estate portfolio, our corporate bond portfolio, our government bond portfolio, and so on, gained a lot of value, mostly between 6 to 9% per year over the last couple of years. Now, what you do see also, this is now the first year in a very long time that we actually see negative economic returns on our asset portfolio. Okay, why is that not worrying? Well, again, we're regulated in a way that gives us huge incentives to invest in a way as a Swiss 15-year government bond would perform. And I can tell you a Swiss 15-year government bond has performed much, much worse than what you see here. They're more somewhere here. So it's actually been a very good news that we had a relatively good performance versus the value of our liabilities. Now, where do now alternative investments come into play? This is, I've just taken a hedge fund index. I know some of you don't like this one. I mean, there are several other ones. By the way, it's in US dollars, so not in Swiss francs. So in reality for us, the returns would have been much worse. But the key thing here is there are two things which strike me. First is there's a huge volatility in this portfolio, hedge fund indices, versus what we aim to do. And second of all, the correlations with what we aim to do here, the black lines, are very low. Actually, it's even negative. So which many alternative investment advisors tell me, look, great, we have an asset which helps you diversify your assets, but actually, no, that's not a good idea. If something doesn't correlate well with fixed income, it will cost us a ton of capital, which our regulator forces us to hold. So we look for something that correlates well with fixed income. And the other thing that doesn't help here is the accounting treatment. The reason why we produced this loss in 2008 is because alternative assets as well as equities are marked at lower of cost or market. So as soon as we produce an economic loss there, we also produce an accounting loss there, and the shareholder has to make up for it. So what has actually our performance looked like over the last 8 or 9 years? It is that you see it's correlated extremely well here with a long government bond index. That's what we like. That's what our regulator forces us to do. And as you'll see, this hedge fund index really didn't help. So what has happened in our asset allocation over the course over the last years? Unsurprisingly, we've reduced our allocation to equities and alternative investments. We've increased our allocation to real estate, reduced foreign government holdings, and increased corporate bonds. Again, it's always for similar reasons that I'll come to here. So these are the restrictions I operate under. First of all, the traditional set of what are eligible assets. Then here, this is our economic framework. That's the revolution I talked about, which came from Bern at the beginning of 2011. And it doesn't help equities, alternative investments, cash, and also high-yield bonds. And then earnings at risk as well. accounting treatments don't help. So in the end, what we wind up doing as Swiss life insurance companies is invest into real estate, government bonds, primarily Swiss ones if there are any ones around, but also foreign ones, and corporate bonds. Now, one thing, and this is now again a chart by FINMA that we have learned from other asset managers, is that it's a good business model to manage other people's money. And this is something we've really pushed to just to explain. Here we see our average economic performance over the last 9 years. It's been, for the industry, it's been around 4%. These are the fees we charge to our clients. That's around 20 basis points per year. And the bubbles are the size of the assets we manage. So of course, why do I show this chart? Well, Swiss Life is the green bubble here on the upper right-hand corner. We really have delivered quite a nice performance for very, very low fees. And that's something I think that other clients like as well. And we started with managing about a bit less than 10 billion assets under management 5 or 6 years ago. And we are now at the end of June of this year, we've managed to come well above 20 billion. And this has really been driven by net new assets. And what we offer here is really access to defensive investment solutions that is primarily real estate is a big block, fixed income, corporate bonds, balanced portfolios, and money market products. So just to sum up, we've really come through this crisis quite well, but our traditional business has come under a lot of capital pressure by the regulator, and we're now seeking to expand our business to manage more of fee business, which has really helped us quite a lot in the last couple of years. And with that, I'm open for your questions.
Who wants to get this gentleman's attention when it comes to raising assets? Any questions, any comments? I can't be doing all the talking, surely.
I guess we have one here.
Thank you. At the front row.
Thank you. I think this was an excellent presentation. I have a very technical question. You showed the mark-to-market for hedge fund assets. What do you do with real estate? You keep it at the historical costs for the official and regulatory accounts, and in your economic value thing, you make also mark-to-market. Is that the right conclusion?
Yeah, now we really get into the exciting details of accounting treatment. You're absolutely right. Under our statutory accounts, it's at cost, so we have several billion of unrealized gains there. Under IFRS accounting, it goes through the P&L and is at market. And in our economic solvency, it's of course at market as well. Right.
Yes, please.
The question I had with regard to your focus on fixed income instruments, how is your performance going to be if inflation spikes?
Well, I mean, that's quite obvious. It'll be more of the same what we've seen this year. It will be negative, and that's actually something we're hoping for. I mean, everybody that working in the financial industry is really hoping, and most of all life insurance companies, is hoping for increasing rates, because that will help the attractiveness and also the profitability of new products. And it will also help us in our economic framework, and it will increase the amount of recurring income. That's the way we're regulated. So the only drawback is really performance you mentioned, but us being a heavily regulated financial institution, that really doesn't matter very much. I mean, nobody asks the other highly regulated financial player, which are banks, is what is the performance on your balance sheet? It's just not very interesting. What is interesting is the way we're regulated, and that's the economic solvency. And what our clients want to see is they want to see that we honor their guarantees, that we want to pay their pensions and the like. And that's not being compromised by higher rates.
All right, thank you. Well, thank you very much for that
Thank
speech.
you very much.
Okay, we're moving on. We are delighted to welcome L.Ellis, President of MAN and a member of the MAN Executive Committee. He's going to be talking about financial turmoil, how the alternative investment industry is responding. I was hoping financial turmoil would be over, but it will be very interesting to get the insights of L.Ellis. I quite like to understand where people are coming from, and Luke's background is, again, very interesting. He was the Global Equity Derivatives and Equity Proprietary Trading Business Head for JP Morgan. Again, lots of insights in prop desks, probably a dinosaur now, prop desk, not many will carry through. He's been through MAN all the way through, but before that, he was a non-executive chairman at GLG, another very famous multi-manager, and managing director of FRM. So I think his insights will be truly interesting. Thank you very much. Let's welcome L.Ellis.
Thank you very much. Oh, is that working? Grand. Well, I guess what I'm not going to try and do is to sell Patrick some hedge funds, if anybody didn't get that. Luckily, within MAN, we also run some long-only bond funds, so someone can go running. Right, nobody told me which one was. There we go. So I guess I was supposed to be talking about hedge funds, and I think one of the bits, just to put it in context against the previous conversation, the answer is if you have the chance to own assets with no mark-to-market, with accrual accounting, you should always favor those. If you live in a world of mark-to-market accounting, either because that's your accounting treatment or because you're a human being who looks at the returns every day, then you have to think about the stability of your returns in mark-to-market, not just over the long term. So where are hedge funds today in the financial markets? That number was on the slide before. So hedge funds are about 2% of the financial markets in terms of assets under management. It's remarkable sometimes when you read the newspaper, you would think that the hedge fund industry was 50% of financial markets, but we're only a little bit. That lets us do a lot of interesting things. Putting it in context, the hedge fund business is about the same size as PIMCO. So, you know, we're sort of there, but then we're not the big boys. That lets people be flexible, and that's really what hedge funds should be about. And interestingly, you know, the title was about financial turmoil. I'm not sure that I think of the world as financial turmoil personally. I think that the world in the run-up to 2008 was a very strange world. We're never going to see the world of the 2000s again, in my view. You know, there's always things changing in financial markets. So the hedge fund industry had a very good run up to 2008, took a step back, and today is actually bigger than it was in 2008. But the growth has been slow and steady since then, which is a much healthier sort of growth. And the total number of hedge funds continues to be reasonably at all-time highs. And the interesting thing is, where does the money come from? So you'll notice on the right-hand side, as you look, that I haven't got insurance companies on there. And it's right, insurance companies are the lowest owners of hedge funds. The interesting thing, in endowments and foundations that are probably the most flexible investors, who are focused on generating returns that they can then use to run universities, to pay out in charities, foundations, and so on and so forth, have been the largest users of hedge funds. And sovereign wealth funds, which are another very flexible, relatively unregulated, and certainly not having their asset allocation driven by regulatory capital type of investor, have been the largest growth segment for the hedge fund business in the last few years. And pension funds, the interesting thing on pension funds is when you look at, so on that one you see pension funds, the average pension fund just below 4%, which hasn't changed that much over the last few years. The interesting things when you look at the top 100 pension funds, so the larger, more sophisticated pension funds, and you find the hedge funds are nearly 10% there. And that's the biggest growing segment of hedge fund investing, that and sovereign wealth funds, over the last 5 years. If you look back to that earlier chart I had about total assets in the hedge fund business, what we saw up to 2008 was an awful lot of private bank capital of one sort or another. A lot of that has left and never come back. I would think there's many people in the room who are rather painfully aware of that. But what's been investing on a net basis and creating all the growth has been pension funds, large pension funds, and sovereign wealth funds. So someone thinks that hedge funds are doing something useful. And honestly, the story about what hedge funds do hasn't really changed. And I'm going to come to it in a second. But just, so the chart on the bottom right, bond yields have been falling in a pretty continuous basis for quite a long time. They may continue to fall. They may continue to stay low. The interesting thing is, one of the most profitable things you can have owned the last few years is long 10-year JGBs. They don't yield very much. They yield sort of 70 basis points. They haven't actually changed what they've yielded for some time. But the carry and roll down you get of the fact that the prices haven't changed has been very attractive. That leads some people to say that you should own lots of JGBs. One might take the argument here as well, but particularly if we stick with JGBs, it's an interesting story because it's been the easiest bond market to trade for the last 10 years. And today we sit here in a situation where you could take the history and say it's the easiest thing to own, or you could look at the fact that the Japanese debt is now, government debt's at something like 240% of GDP, and maybe think that there's a crisis coming in the JGB market in the future. I have a view about bond yields, but I'm not here to make a pitch about bond yields. I just think it's very important that one doesn't look at recent returns of passive investments. It's been a good beta market in equities and bonds for a while, and particularly in bonds for some time, and extrapolate that out into the future. The one thing we know is you can't get the same capital gain treatment out of bonds over the next 10 years, capital gain benefit that you've had in the last 10 years over the next 10 years. The sort of math doesn't allow one to go that low. The other bit on the left shows generally the investing problem that we're all suffering from. We have a significantly aging world, and that is in large part behind what's been behind the drive down in bond yields. So, one choice is to take bonds and sit on those as a passive investment, and if you don't have mark-to-market treatment, that can, you can get a reasonably certain return over a reasonable period. But here's another way of looking at hedge fund performance compared to a portfolio here in Switzerland. Now, I would recognize again, the point is, if you have a capital that gets driven by government bonds, then you don't like this lack of correlation. For a lot of the rest of the people in the audience, I would think this lack of correlation is rather an attractive thing. What it shows is basically periods of good bond performance and what you've been able to get out of a hedge fund portfolio. Again, this takes an index. It doesn't take our direct returns. And it takes the periods when bond returns have been weak, and it shows what you get from hedge funds. And actually, on a relative basis, aside from a window in 2008 that was pretty painful, the actual relative performance has been pretty good, and particularly if you take it over the longer periods of the cycles of the bond market. That lack of correlation is the biggest thing that hedge funds have going for them, and it's by design, not by result. If you take on the, sorry, I'm not very good at left and right for the way you're looking. On the left, you have a collection of, in this case, it's equity mutual funds, but we could have picked any particular sector where you've got traditional investments, traditional asset managers in a particular sector, and you see, give or take, the managers all look roughly the same. Interestingly, they all make basically exactly the same return, but with slightly varying volatility. So if you pick well, you get a slightly less volatile version of the same return, but there's not much return differentiation. On the right-hand side, you have a collection of hedge funds. Again, randomly selected equity hedge funds to be the representative thing compared to the picture on the other side. And what you see is the returns and the risk numbers are all over the space. There's a lack of correlation between individual hedge funds. That's by design, by process. And so what you will tend to get when you put them together is something which can be uncorrelated with other assets in your portfolio. It's not always, and it's one of the earlier numbers had 10,000 hedge funds. One of the things of 10,000 hedge funds is if you pick the wrong ones, you can build the opposite of what you're trying to do, and if you pick the right ones, you can build exactly the thing you're trying to do. So I wouldn't say all hedge funds are the right solution for all people in any sense. But this ends up being the picture that one always comes back to in looking at the hedge fund business. So, which one did oh, there we go. So look, here's the bid in 2008, which was painful. Interestingly, compared to equities in 2008, it wasn't as painful, but it was a very painful experience for most people in hedge funds in that period. The interesting thing, though, is if you look at the longer-term returns, and even if you ignore the early days of the 90s, when I would fully admit it was easier to invest then than it is now, but start in the 2000s and look forward, the compound return is actually very attractive. It's attractive because of cushioning of drawdowns. So again, it's down here. I'll stop trying to describe where it is on the slide and just try and point to it. If you cushion the drawdowns and you're patient through time, you get very good compound returns. Hedge funds are not a way of trying to make some magical 15, 20% return every year. I'm afraid in a world of 1% government bond yields here, 3% bond yields in the US, and LIBOR rates of 0 in most of the world, and probably most of the world for most of our future career, the answer is 15% returns aren't realistic. But hedge funds are a way of making consistent, steady, bond equivalent type of returns in a world where bond rates, the capital gain side of bonds may go in the opposite direction. That's really what the hedge fund business is about. So when one thinks about coping with the market turmoil, really the answer is the best of the hedge fund business has got back to business as usual. There was a period sort of here in 2006, 2007, when the hedge fund business got over-carried away in the same way that reasonably everything in financial markets got over-carried away. And the best of hedge funds basically recognized the problem, took their licks, buckled down, and concentrated on fairly basic things like picking stocks, picking bonds, just trying to add value through hard work rather than chasing some mythical super return. There has, though, been a response to it's a response to the fact that today's investors, the primary sort of driving investor of the hedge fund business today, are pension funds and sovereign wealth funds, as I talked about before. For those people, portfolio transparency is incredibly important. It's important because it should be important to everybody. I have a personal belief that if you invest in a hedge fund, if I invest in a hedge fund, it's my money that the person's running. So I think I deserve to see everything that's going on in that portfolio. And we as a firm have a philosophy that you should be transparent. From the sophisticated investors who are investing in the business today, they want to understand exactly what's going on with their money, and they want to be able to see how that compares with other things in their portfolio. There's a lot of stuff written about how diversification is the one free lunch. Well, diversification is the free lunch unless what you have is offsetting positions. If you're long one thing and you're short it in another pod, that's a perfectly diversified position. They will go up and down at opposite times. The trouble is you're guaranteed to never make any money because you own something and you're short the same thing. So it's important to understand what your managers are doing so that you're actually getting diversification as opposed to offset. Today, people ask about leverage, but really it's about risk understanding. There's no excuse for a hedge fund manager not telling you exactly how they manage the risk, exactly what risk they're taking at any one time, exactly what the methodologies are for looking at that. There's really no excuse for not being fully transparent on that. The only time you can get to thinking about constraints on transparency, frankly, are driven around whether you have a position which is, the sort of the mythical short position which, if people knew about, you might get squeezed. Honestly, the amount of hedge fund alpha that comes from those sorts of positions is very, very small. You get a few very large managers who are concentrated in certain things, but otherwise it's really not a big issue. So you should get transparency, and the best of the hedge fund business today provides clear transparency and provides analytics. And to something somebody was saying earlier about banks have all become technology companies, well, luckily we haven't become a technology company, but we have partnered with some technology companies to make sure that we can deliver the technology to you. The beautiful thing today is you can get all the information on your iPad, your iPhone, or whatever other device you happen to use if you're not an Apple type. The result, though, of two bits, I'm going to actually go forward and then come back. Here's a sort of picture about what's going on in regulation. We heard about tax regulation earlier on. There's been a huge amount of other regulation which is affecting the hedge fund business. Honestly, I don't think any of it is bad for the hedge fund business. I don't think any of it puts people off running hedge funds or makes them run them in a particularly different way. The only thing that's difficult is the lack of certainty one gets with the frequency with which regulations change or get put off or get redone. So we've had to redocument most of our funds 5 times in the last 5 years. It pays a lot of legal bills, but that's not good. But there's a lot of regulatory change going on. And basically what that's led to, between the need for transparency together with the regulatory change, it's led to a concentration of the assets in the hedge fund business. The hedge fund business today, the flows have been dominated by flows into the largest hedge funds. As you could see, all of the net flows and more have gone to the largest over 1 billion hedge funds. Now what then becomes important is, that's just another version of that story. This is the UCITS flows. Here in Europe, I should be careful saying here in Europe. I'm used to giving this presentation in France or Germany or somewhere. In core Europe, today, 75 to 80% of the hedge fund flows go into UCITS structures. UCITS has just become a necessary thing for everybody doing something in that market. So where does it get us to in terms of what we've got today? The thing of the hedge fund business, it was about having creative entrepreneurial fund management. And I would argue that in a people business, which investing is clearly a people business, creative entrepreneurial fund management is still the way to get better returns. The issue against that is the need for regulation, the need for transparency, the need for technology, the safety and security that people are looking for in today's investing world means that you have to find the balance between institutional infrastructure and entrepreneurial fund management. On that basis, the hedge fund business continues to do fine. It's a growing asset class, or it's not really an asset class, it's just a style of running money. It's growing in most of the world. The one place that it's been slow to rebound is in the private banking world, which I know affects the market here very much. But actually, notwithstanding the fact that it doesn't work for Swiss insurance companies, hedge funds are an embraceable asset class. So with that, I've been told my time's up, so thank you very much.
Thank you very much. We can take some questions.
If I'd known we were waiting for questions, I'd have talked longer because
I
nobody likes asking questions.
No, we've got a very interesting audience today. There's one at the front.
I have a question you didn't mention. What about the pressure on fee levels and keeping up your margins? That would be the first question. And the second one, what do you think about the future of multi-strategy products versus more single style?
Sure. I think so on the fee level, I think, so I have different hats. I have a hat where I run a series of hedge funds where I'd love to tell you that fees are going to stay as high as possible forever. I have another hat where I run a fund of funds business that invests in other people's hedge funds, where I tell you we negotiate fees every day very hard. I think the reality is that the world where every hedge fund could get 2 and 20 wasn't a sensible world. It was part of that, as I say, I think when the history of finance is written in 50 years' time, the 10 years of the 2000s will be the chapter that everybody reads because it's the really weird period. I don't know what name they'll come up with it. It can't be the 2000s, but there'll be something, because that was a very strange period in finance. And everything in the financial markets, basically whatever you did, you were overcompensated. Banks were overcompensated, hedge funds were overcompensated, people were overcompensated. It was a very odd world. And the idea that every hedge fund deserves the same fees doesn't make any sense. In every market, scarce resources get premium pricing and things that aren't scarce resources get lower pricing. That's what's happening to hedge fund fees. It's happening relatively slowly, but it's happening without any doubt, so that the premium products can command a 2 and 20 and should be able to. But to be a premium product, you have to have scarce capacity and very high alpha. At the other end of the spectrum, you can look at the diversified growth funds. They're basically just a form of hedge fund. So Standard Life GARS is the sort of most famous one. It's now 30 billion pounds, I think it is. It's basically a hedge fund. It's just done in a very big size, and so the fees are commensurate because there's no scarcity factor to that. So it sort of seems to me you're getting differentiation in fees in hedge funds, and nobody deserves to get 80% of the alpha they generate in fees. Sorry, but I say that to the people who work for us, I say that to our shareholders, and I say it to anybody out there. The question of multi-strategy is sort of coming to that bit at the end about the balance between delivering the infrastructure and sort of keeping the creativity and the entrepreneurial approach. We have a specific business model to deal with that. I think that you get a spectrum of answers, so you'll see specialist niche hedge funds, you'll see fully multi-strategy shops, and then you'll see things in the middle that are trying to create a different way of bridging the issue. I could give you the sales pitch for our thing, but I suspect that's out of bad form in this room. So, the one thing I would say is I know very few people who can pick hedge fund sectors and say which one's going to do really well in the next 6 months or 12 months. There are a few people who can pick asset classes. You can pick a beta and make a bet in that for the next 12 months. But to do it successfully on picking a hedge fund style for the next 12 months, I think it's very hard, even if I'm going to get asked the question later on the panel.
Okay. I think in view of time, we'll leave it at that. Thank you very much.
Thanks very much.
Now we're moving from the private sector to the state sector with Edgar Kresin, who's treasurer at the Ministry of Finance of Saxony-Anhalt. He's been there for a very long time, in fact since 1998, so I guess he will have seen everything and anything. He started as the head of transaction and liability management. He was then appointed deputy head of treasury. That was in 2003, and became treasurer thereafter. And since 2006, he's also been responsible for asset management and debt management. Let's give him a warm welcome.
Thank you very much. So, it's very interesting for me as a civil servant talking after a hedge fund manager. So, it's not very often to stay in one row. And the second thing that I just recognized that for me it's a big pity to have so much investors right here. Normally I would like to give fixed income presentation, but I don't have it with me. So today I was asked to give a presentation which implication the changing capital market has for German state treasuries, and I try to do that for you. So first of all, what is the German state? In Germany we have two concurrent levels of government. These are the states and the federal government. So from the constitution we are equal. And everybody has its own parliament, its own budget, its own government. That's very important to know. So we are independent regarding our budget against the federal government. We have clear responsibility due to our constitution. This is police, education system, and also municipalities in Germany. German states, we are 16. Saxony-Anhalt is one of them. So there are Saxony, Lower Saxony, we are Saxony-Anhalt. These 16 states, they have around 50% of the overall budget, of public budget, is run by German states. And the debt, it's around 1/3 of the public German debt is debt of states in Germany. Regarding Saxony-Anhalt, we're only a small state with 2.3 million people living there. And giving you just an idea, when I talk about treasury in a state, what does that mean for us? So our budget volume yearly is around 10 billion euro. Our debt is 20 billion euro. And our assets under management are 1.4 billion euro. It's not only pension savings we have here, or savings we want to use in future for pension liabilities. It's also different assets we have, or liabilities standing behind that asset we build up. Meaning in figures on the debt side, that means we had around 500 bonds or loans from 1 to 30 years maturities. We like to pay low yields for long term, also for Swiss insurance companies as investors. We are very flexible doing instruments regarding documentation, currencies, and also structures. And we are using very actively derivatives, meaning swaps. So our portfolio here is around 9 billion euro. And I try to show you just why we do that. The simple thing is, if you're doing debt management, you try to get as cheap money as you can, so you're offering a special kind of documentation, and also maturities and structures. So if there are some investors looking for special equity-linked structures or something like that. When we're offering that, of course, we have to illuminate every structure we don't like. So we only like fixed income euro or fixed rate euro or floating rate euro. So we use swaps for that. Afterwards, we have a kind of fixed rate and floating rate portfolio we probably also don't like. It just was the cheapest. And we manage that just by doing simple swaps, paying and receiver swaps, and just changing our fixed and floating ratio in our portfolio. And when we have that, we additionally use swaps to add structures, interest rate structures like steepening swaps in our portfolio to being more efficient on our debt structure. So we have a lot of swaps in our portfolio. When interest rate increase, we will profit from that. So that's very good for us to have just for diversification. If you only have one issuer with two products, floating or fixed, we can add one additional product like inflation link or I don't know what to diversify our portfolio. That's very important. That's the reason why we use swaps. So, and now when you know what we are doing, so Of course, there are implications of changing capital markets, the German state treasury field. So after 2007, it's quite, for Germany, it's a boring story. I believe in South Europe it was more interesting. But even in Germany, a lot of things changed, and if you look into detail, that will have a big influence how we deal in future with what we are doing, debt management. So first of all, we have a declining number of counterparties. That's the problem. So if you read newspaper about Italy, they weren't very happy when one big American investment bank canceled all line with them. So they are looking for counterparties. It's the same for German states. If you run a debt portfolio of 20 billion euro, you're happy about, and 9 billion euro swaps, you're happy about every counterparty is able to do business with you. And that's declining. So I believe, I'll show later some numbers about that. The funding business also changed dramatically because there's one thing disappeared in 2008, that was the hypo banks. And they was very useful for us because when we had hypo banks in Germany, they just took our debt, they don't care about maturities more or less. So just we decided for maturity, we had a flat spread curve, and saying, okay, I like the 10-year, and we get the 10-year from the hypo banks, and then they just offering Pfandbriefe, and they made the transition of interest rate risk. So they made that game, they lost, now they disappeared, and we have to look to the investors right now looking for long-term debt or short-term debt, and we have to find an access direct to these investors. Liquidity management, also big topic for German states. So even tax income runs in Germany very well over the last years. Nevertheless, first of all, normally I like to have negative cash because it's cheaper, because of steepness of the curve, and the access is very easy for German states to get liquidity. But that changed after Lehman. So first of all, we recognized, oh, there could be a refinancing risk. We never recognized before in Germany as German state. Second is, now we have to make collateral management due to the market prices and swaps. It's very important for us. Right now, we had just cash of 500 million in our liquidity. We get collateral from banks due to our contracts we have, and that's a lot for us. And even that can increase to some billions, and I don't want to have that money, to be honest, because I have to put it somewhere. Yeah. And that's not our core business. Risk management also is very important. So if there is a declining number of counterparties, also counterparties right now ask you what kind of risk management you have, what you are doing. That never happened before. Right now, banks are very, very keen looking on their reputation risk. And that means also they want to understand what kind of risk management you had, how you monitor that, and everything. So right now, I would say no risk management, no business. That should be in the next 4 or 5 years. That's my opinion, and we are going to that direction. Transaction management, that's something to think about. Banks are efficient. We don't believe that. In the back office, it's a nightmare with all the regulation coming to banks that spilled over to a workload to the clients like we are, that transaction management, now the operating risk increased enormously after Lehman. And that's something like every payment we have paying back interest rate right now, we need 3 calls with a bank, and they ask, okay, will you fulfill your contract today? We say yes, and that's 3 times a day for one payment. And that's something, it's not efficient, and it's a lot of work to do right now. Asset management, here it's something pretty new since 2006, even before Lehman. Germany, the federal government, and 8 of the 16 states started to build up pension funds. So right now, I believe we are around 10 billion euro, building up our own pension reserve for future pension for civil servants. That's pretty new, so asset management is a new topic. And we started with we are unregulated, but we started with a pure government bond portfolio, and now diversification is becoming more and more important for us. So just give you some implications. First of all, after crisis, we have a steep interest rate curve. That means short-term rates are lower than long-term rates. For us, it's a carry to pay if we want to get to a longer maturity, and that's something we have to consider. So for a state treasury, it's cheaper to go down with the duration. Yeah, that's not what the taxpayer wants to do, but the parliament, if they're looking for a balanced budget in the end of the year and they need some more money, it's always a discussion about just going down with the duration and we have some money and everything is fine. And this discussion we have since the last 4 years, nearly in every state in Germany. Second thing is state treasury bonds, so that's always my fixed income presentation. So we are the same credit quality than the Federal Republic of Germany due to constitution, but we are offering a higher yield. So the lower graph shows you the Bund performance, and the big blue stable graph is the state performance, and that means due to the oil crisis, we were a very stable investment. So if you want to have same credit quality, higher yield, just invest into Saxony-Anhalt. Keep that in mind, please. What changed, or what is very important for us, what changed is the spread curve we had. Not only from the parliament or from the politician point of view, also from the spread curve point of view, it's more interesting for us just to issue shorter debt, because due to regulation on the banking side, banks have an enormous demand for short-term bonds, because they need that for their liquidity. So we have a high pressure on the short-term spreads for German states. That the actual graph, I believe, is this here. So you have a spread of 20 basis point and average interest rate of 1% over the maturities. So it's 20% what you can save here. That's enormous, just to change your funding policy to more shorter debt and not long-term debt. So it's a high incentive to go to short-term debt. And that will be stable due to regulation, I believe. And that's pretty new. So 10 years ago, when I started there, we had one price for 1 year, it was -6, and for 10 years, it was -6 against swap rate, and for 30 years, it was -5. So that's all. And that changed. And that's pretty new for civil servants like us. We like if nothing changed. So. What also changed is the demand. Here I just show you the structured we issued in the year 2004 to 2007. So that's investor demand for structured, and we are able to issue that and swap it into fixed or floating rate in euro. And that changed dramatically. So right now, less structures, less complicated structures. It's only one exception. It's the portfolio-linked structures. This is very tailor-made German insurance structures we are able to issue. They are not plain vanilla, it's the other way around. But nevertheless, many things disappeared right now from the market. And that's also for us pretty new. So if we have here FX bullet structures, they're mostly short-term. Also a number of dealers here, and the requests we had declined very much from over 350, for example, requests we had in 2010, down to 120 just, or probably 200 by end of the year 2013. And that's much. Number of dealers here you can see declined from 34 to 19. That's important for us. Yeah. And that's also have implication on prices we are able to get. Risk management. No risk management, no business. First of all, no collateral management. Business will be more expensive, so we introduced that. But with collateral management, you of course have implication to liquidity management and other things. Second, you have to go out and explain what you're doing. So we were out and talked now to over 9 or 10 big international investment banks and met the risk managers and the compliance managers and explained how we look to our portfolio. And that's pretty new, and I believe that will continue due to the very high reputation risk banks right now are looking at doing business with public entities. Investor relation becoming more important, I believe. So I just mentioned hypo banks did that in the past for us, but right now we have to find on our own the investors. So State of Saxony-Anhalt is doing that since 1998, but it's becoming more important, going out and talk to investors and also intermediaries, so going out to London, which structures are on vogue and I don't know what. Ratings are becoming more important and also going out to intermediaries, as I mentioned. Asset management, probably the last point, so I just mentioned, we started that in 2008. Right now our actual portfolio is, we have European government bonds, corporate bonds, European equity and global convertibles. And we will increase that diversification on our portfolio, definitely, but for us it's something, because we're a public entity, like investing in forests or I don't know what, doing equities, because it's a big step coming from only state treasury bonds are the thing where we are allowed to invest now to doing equities or something like that. So we already did big steps, but we have to move further. There we are on the way, but the more important thing is we had to find out a kind of own asset management architecture, how we make that. So we have one boy sitting here. That's the Mr. Anhalt. So the Mrs. Saxon we didn't find, but if we have then we will enlarge to 2 people. So Mr. Anhalt is sitting here and he's doing the whole asset management for us. So that means communication with other ministry, parliaments, and also our Minister of Finance. But then he's not only doing that for the pension fund, he has now 3 other funds. He needs to do that, and we have 6 foundations integrated in that system and 4 companies from the state integrated in that system. And all had their own accounts at the global custodian. And behind that, we build up funds with a special fund administration office in Germany. And then we have asset manager for special asset class. That's how we make that, and we are quite open for every family money to put into that system. That's politically very, very important after Lehman. If Lehman comes around, you need to inform on the same day your parliament what kind of money of the state, where it is it involved or not. And now we are able to do that. So I'm coming to the end. Thank you very much.
Again, we have time for a couple of questions or comments. And surely a prime client for many of you. Anyone has any thoughts, or are you all very hungry for lunch? Okay, well, we'll leave it at that. And you're off the hook. Thank you very much for your presentation. Thank you. So now we'll all go to lunch. Lunch today is kindly and generously sponsored by Novus. So we're very grateful. Novus was founded in 2007 in New York by a group of investors, data scientists, and engineers. Novus is a platform to help investors generate higher returns, something we all want to do. So later on today, we'll also have the privilege of hearing more about them from Andrea Gentilini, who's the head of Europe. So thank you very much for this lunch. See you later. Or I should say, please be back at 1:20, please.